Have you ever wondered where your money goes when it sits in a savings account? It's not exactly gathering dust in a vault somewhere, but the inner workings of banking can feel a little mysterious. So, if you've ever asked yourself, does EQ Bank hold my funds? Then you're definitely not alone. Today, we're going to crack open the piggy bank of knowledge and take a deep dive into how EQ Bank, and by extension most banks, handle your hard-earned cash. We'll explore the concept of fractional reserve banking, delve into the safety of your deposits, and answer the burning question of where exactly your money ends up. Now, EQ Bank specifically is known for its high-interest savings accounts. That's a big draw for many Canadians looking to make their money grow a little faster. But those high rates come with some interesting mechanics behind the scenes. Here's the thing, when you deposit money into EQ Bank, you're not simply putting it in a locked box. Banks operate on a system called fractional reserve banking. In simple terms, this means they don't hold on to every single dollar you deposit. Instead, they keep a portion on hand to cover everyday withdrawals and transactions, and then lend out the rest. Let's use an example. Imagine you deposit $1,000 into your EQ Bank savings account. EQ Bank might keep 10% of that, or $100, on hand to meet your potential withdrawals. The remaining $900? That gets loaned out to other individuals or businesses who need access to capital. This might sound a little risky at first. Where's the guarantee your money will be there when you need it? Well, that's where deposit insurance comes in. In Canada, the Canadian Deposit Insurance Corporation, CDIC, protects eligible deposits up to a certain amount, currently $100,000 per qualified account. So, even if EQ Bank itself were to face financial difficulty, your deposits are insured by the CDIC. Now, let's address the elephant in the room. Where does the loaned out money go? This is where things get interesting. Those loans can take many forms. EQ Bank might use your deposit to fund a mortgage for someone buying a new home, a business loan for a local entrepreneur, or even a line of credit for someone consolidating debt. By lending out your money, EQ Bank can generate income through interest on those loans. That income is what allows them to offer you those attractive interest rates on your savings account. It's a win-win situation, in theory. You get your money to grow, and EQ Bank uses it to fuel the Canadian economy. Of course, there are always risks involved. If borrowers default on their loans, EQ Bank could lose money. That's why they carefully assess the creditworthiness of anyone they lend to. But again, deposit insurance helps mitigate that risk for you, the depositor. So, to answer the initial question definitively, yes, EQ Bank holds your funds. They keep a portion on hand for daily operations, and they lend out the rest in a way that's regulated and insured. Here are some key takeaways. Fractional reserve banking allows banks to offer higher interest rates on savings accounts. Deposit insurance protects your money in case of a bank failure. Loaned out funds can help stimulate the economy. Understanding how EQ Bank, and by extension most banks, manage your money can empower you to make informed financial decisions. Whether you're looking to grow your savings or simply keep your hard-earned cash safe, knowing the system can give you peace of mind. With that said, thanks for watching, and until next time.